Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending September 30th, 2022. And this week I'm going to title the video, "The Dollar Breaks the World and Retail Investors Run for the Exits." It's a long one, but it was a busy week and a lot happened. So I want to go over that all as much as I can for you today. So we're going to start off with some economic data. The PMIs, Chicago PMI, that came in roughly flat. So that was for the month of August, a little bit delayed. Same with this data, the recession probabilities, now up to 25%. And if you go back, that's the highest level, since the COVID crisis. And, we had one back then. I think we're going to have one this time. It's just a matter of how severe it will be and how much is already priced in. So just wanted to highlight that. Now, interesting data point today was or not today, but I think this was Wednesday it came out, was the new single family homes sold month over month. That was up 28%. And it just shows you that the area where you're going to see supply come on for homes is going to be mainly in those single family home, those new home market. Why? Because the average individual, they're locked in their 3% mortgage and they don't want to go get a 6-7% mortgage now when they go buy another home. So I think the home builders are going to hold up relatively well. They have to do some price cuts and probably have to buy some points for their buyers, etc. But ultimately that is going to just mean lower margins, not necessarily negative margins, and they're likely to still move a lot of homes, and they did last month. Now the Richmond Fed survey that came out, it was at 0, right? So a nice improvement from -8 in August, and then this is September, so it's pretty up to date. And with all these deeper manufacturing surveys, what's interesting is always looking at the price data, because that's going to give you a more real-time view of what's happening with inflation. And that did come back down to 10.3%, the lowest level in over a year, lowest level since, when is this? Going back to June of last year. So you're definitely seeing some moderation in prices. Order backlog index, that continues to be in negative territory. So, working through that order backlog, which makes a lot of sense as the economy slows. Now, I wanted to highlight this, and I keep looking at it because it's very important right now to see, how far the Fed is really going to go. I think they're up to the precipice of really breaking a lot of things, and they did, which I'll get to in a second, in the foreign markets. But you're starting to see some shifts in Fed rate expectations. Now, last week, we were at 73% chance of a 75 basis point hike. Now it's down to 53. This is in November, the next Fed meeting. Okay, so this is showing that the market is starting to price in a different Fed policy, a different Fed path that is a little bit more moderate. And now it's roughly a 50-50 shot between 75 and 50 basis points in November. And then you move back out to December, same kind of thing, right? This was a 70% odds of a 75 and another 75 for December. But that's come down to 48%. Okay. So, and so that's starting to moderate. And you go all the way about to February, and that was 66% chance. It would be 75, and then 25, all the way to 450 to 475 from where they're at now, which is 300. And that's now unlikely. So what's more likely is here being at 425 to 450, which is only about 125 basis points from where you're at today on the Fed funds rate. So just wanted to give you that perspective and update on that side of the market, because I think it's super important to understand. And I think the reason the market's moving is this. The Fed is planned an emergency meeting for Monday to talk about the discount rate. Okay, and this was scheduled on Thursday. Okay, so they're seeing things break. And what else is breaking is the confidence of the retail trader. This is weekly order flows from retail traders. Look at this last week of September. Just absolutely puked from the retailers. So that's why I put the title of this video, Retail Investors Run for the Exits. Okay, so that's a little bit of overview there, but let's dig into the charts. You had an attempted bounce on Wednesday, and that frankly failed. It was a one-day thing. I said this was an outside reversal day, but any outside reversal day, you need follow-through. And I said, are we going to get some follow-through? And we didn't. We didn't get that follow-through. Now, what we are getting some follow-through in is the rates market. Now, here's SHY, short-term rates. So that surged on Wednesday. That was kind of that hope that the market had that the Fed would be shifting, would be pivoting, and while that didn't get a follow through, it didn't fully revert. It didn't really reverse either, right? Look at this move. This is where we closed down at 81 on Tuesday, and then we closed all the way up to 81.40, which is a big move for this, right? This doesn't move very much, but we're still over halfway. Closed the week over halfway into that move, and it just tells me that this kind of hope the market has the Fed will pivot is not, I don't think, unfounded, at least quite yet. Look at the 10-year as well. Same type of thing. Big reversal on Wednesday, but we're just kind of chopping within that candle. So until we get back above that, I don't think rates are going to go higher, right? Above the candle, the top of that candle on Wednesday, which is around 3.9%. Closed at 3.8%. So you look at the currency market as well. Here's the UUP, the dollar reversed on Wednesday, and that actually did have follow through to the downside. If you look at FXE, that continued to remain strong. FXB, which is the British pound, they're having pension blowups, and the BOE stepped in, and so that's had quite the impact there. And then the yen. That's the one that didn't really have a whole lot of follow through to the upside, mainly because they continue to keep rates very low. They're stepping in. They're doing some things to support the currency, and mainly that's why the dollar, I think, or not the dollar, the 10-year Treasury rose so dramatically. To support the yen, they're going to have to sell dollar assets, and mainly the Bank of Japan, they own a lot of treasuries, and so that's why you saw rates up. So, the Fed is breaking things worldwide, and that's the issue. That's why they're having an emergency meeting. I talked a bit about the fact that on air today, this week, that the financial crisis was consumer driven, and governments through bailout packages and through the structure to try to re-liquefy the economy, that kind of kicked the debt for those names upstairs to the corporate level. Okay, so then the corporate level had a bunch of debt, still has a good amount of debt, but then you had the COVID crisis, and what they did was with PPP loans and a lot of government policy, it took the, think of Boeing, for example, right? The bailout of Boeing. It took a lot of corporate debt and kicked it up to the sovereign level, right? Our government debt, and that kind of happened around the world. So, what you're seeing here is when the Fed tightens policy, they're breaking things on the sovereign level. Like I said, with Bank of Japan, Bank of England, what's happening with the euro, what happened in Sri Lanka, right? Just the strong dollar really just breaks everything. And we're at really extreme levels here. Here's the weekly chart. Look how extended you are from all the major moving averages. That's very atypical. That typically will come back down. You could have a long-term uptrend of the dollar, and I think that's certainly possible. But this is very extended, and I expect this to come back in because, once again, you're really breaking this when you have the dollar move so dramatically in such a short period of time. Now, what's interesting here is small caps continue to outperform. Here's IWM to the SPY. You had a bit of a pullback late last week and into early this week, but you got a nice rally over the last 4 days. You also have the growth side of the market. Here's, oh, just, there we go. Got to type that in correctly. You're getting that rollover here. You try to hit that resurgence. You're getting the ARCs of the world, continuing to grind lower. I believe Kathy Wood resigned from 2 of the funds. I don't know if they're shutting them down, but it's the first sign I think of I've seen of capitulation from this space. And you had some rough earnings. Nike had some rough earnings this week. Really a market bellwether. And what else? Energy continued to be relatively strong. Let's go to DVC. That was USO. DVC, broad commodity index, that actually held as well. The fact that we had that reversal on Wednesday, you had a little bit of a pullback the last 2 days, but the commodity space I think is poised to take back off if the Fed does pivot and you get any weakness in the dollar. Think about how strong the dollar is, and this is the commodity index. It's had an impact lately because of just how parabolic the dollar has gone, and the steps that with the strategic oil reserve and all that have really taken the winds out of the sails of energy and many commodity indexes. But if the dollar can get some weakness, I think the commodities really take off. And I want to get to gold real quick because gold, that one did have a reversal. And it's stuck, right? It had a reversal on Wednesday, and it's just consolidating the last 2 days. Yeah, it had a pullback on Friday, but overall it's pretty minor. And you look at GDX to GLD, that's also starting to outperform. And so these are signs that the Fed will pivot, and it's sniffing that out. Here's GDXJ to GDX. You had that pullback, but this continues to be relatively strong. The junior miners compared to the adult miners, call them. And so I think gold and silver they're having their day, starting to have their day. And look at silver to gold. That also, that had that big breakout a couple weeks ago, and it's consolidated it. I think precious metals are poised here in a short period of time to have a much bigger move. So I think that's it, though. It's certainly a bearish setup, but the VIX. Oh, actually, let me get to the VIX. Yeah, the VIX was very, very high, and up north of 30, and that typically does mark at least a short-term market bottom. So, the charts, you can't argue they look fairly bearish, but you're starting to get indicators of a Fed pivot, and that will create a very strong counter-trend rally. And I'm still expecting that for Q4. How high do we get? We shall see. A lot will depend on how strong that pivot is, how resilient the economy is, how weak the dollar gets, all of that, and we'll keep you up to date on that. So I want to thank you all for tuning in and subscribing to this channel and liking the video. And I hope you have a wonderful weekend. And I remind you that the contents of the video are for educational purposes only. They are not a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Thank you all, and have a great weekend.